So yes, you can see that they have a fairly strong line of credit to tens of millions of debt, and they are paying a variable interest rate. Now, given the RBA has actually cut interest rates twice, I would imagine this would contribute to the bottom line of this company. So I think that is something that hasn't necessarily been priced in by the market yet, due to the fact that it is a very small cap kind of stock. I do believe that you can get a bit of advantage in terms of not as many eyes on it and greater probability for inefficiencies in the market of this particular stock. So that's a positive. The interest rates are usually locked in for around 90 days. So I imagine that kind of benefit from the lower rates aren't going to kick in immediately, but they will kick in at some stage. For me, the time frame of this particular trade is really, I'd like to hold it forever and just collect the dividend yield as long as it stays healthy and at a nice rate of 5 to 7%. I really can't complain. So I guess you could call it an investment. Like I said, I don't really worry too much about what I call it as long as I understand the objective and timeframes of the trade or investment. Now, it is important to note that because it is, now this is the half-year consolidated statement of comprehensive income, but you can see that gaming revenue is quite substantial, as is gaming tax in terms of this business. So that does raise the risk of regulations on gaming or gaming operation hours affecting the bottom line of this business, which could potentially reduce revenues and thus profits. Not to mention that food and drink ingredients can fluctuate in price, so that's another risk. And as you can tell, if I look at hotel operations, there is a fair amount of it actually being attributed to the selling of food and beverages. So those are substantial risks, but I do believe that I have enough of a margin of safety just due to the fact that I believe that the dividend yield is quite sustainable, and the alternative to this kind of a dividend yield is getting 2 to 3% in the bank. So I would rather take a bit more risk to my principal and collect this dividend yield. Although if we do see that dividend yield being adversely affected and see it brought down to 4% or so, or let's say 3% fully franked, then I would consider exiting this position. That is one of the exits. Having said that, there is a fairly high net profit after tax margin of around 6% for the past couple of years on this particular stock, and I think that is fairly impressive because that is an after-tax assessment, which means that there is quite a ways for profit to fall for this stock to no longer become profitable. So I think there's a bit of fat built in. So a fairly decent amount of free cash flow. And that's really the fundamentals that I'm currently looking at for this particular business. A few other things that are worth pointing out is that you can see here the directors: Joseph Michael Ganem, Gilbert DeLuca, etc. Let's just call the rest etc. They actually hold a fairly large percentage of the stock. DeLuca, sound familiar? DeLuca. Gan Boys, well, if you read into the notes, I believe that's actually companies that are owned or controlled by Joseph Michael Ganem. So they own a chunk. Gan Boys, Gansons, Gan Bros. Yeah, they own a chunk of it. Joe Ganem Super Fund, Paul Ganem, Mrs. Allison Ganem, Joseph Ganem, Gan family. Oh, well, I guess that's probably not Ganem, but if you really look at all that kind of add up, a fair chunk of the stock is owned by insiders, which kind of gives you a bit of assurance that the directors and the insiders will operate in a way that is favorable to shareholders, since they have vested interest in it. Also, this is not a stock that's widely held, with around 500 or so shareholders. Now, moving on from that, in terms of the rationale for entering this trade, the income strategy portion of my portfolio definitely does need more risk. Something I've been working on as well is just a risk profile here of the income strategy. You can see that I've only got less than 2% risk in the portfolio, so it makes sense to be putting on a bit more risk. In terms of correlation, most of the portfolio is in cash, so there's not a large need to consider that at the moment. The technical behavior of this chart is that it is in a long-term uptrend, and it does look like it's ready to break higher. Into market-wise, we've got rates going down, which is beneficial to the bottom line of this business. We do have the trade war and the fact that markets may potentially look like they're topping out. So that does raise a bit of concern over the medium term of a risk-off environment, which probably wouldn't be too advantageous for this stock, just because of the fact that if the economy is affected, then the bottom line of this company is going to be affected. But once again, there is that margin of safety. I'm getting something like a 7% pre-tax dividend yield, which is a heck of a lot better than 2 or 3% in the bank. Furthermore, in terms of what I see happening, I believe there's going to be at least a 50% chance that we're going to stay above the 95-cent level around here. Here, I don't think it will be a large likelihood that it'll go lower than 95 cents. So at least a 50% chance that it'll stay above that level over the next 5 years. I think there's going to be a 20% chance that it just does nothing and pretty much goes sideways. and then a 30% chance that, you know, let's say the economy is affected or for whatever reason this stock gets pummeled. I do believe it can get back down to 80 cents, which is when I would really be considering exiting my position. Now, if the price does move up, I would actually continue to buy the stock if I can confirm via research the fundamentals are still sound and warrant the purchase of more stock. If it does go down, I'm going to be getting out at 80 cents just because obviously as a retail trader investor, I don't have as much access to knowledge and I don't have as much time to research the happenings of this stock, so I will have to accept my own fallibility and exit the stock, I believe at around 80 cents, because who knows how much lower it could go, who knows if it could stay in business. Not me, not I, not for certain at least. And for me, the aim of the game is to manage risk and protect my capital. So psychologically, I do feel like I am more attached to this trade than others because I have spent so much time pouring through the financial statements and the annual reports of this particular stock. So I will keep that in mind to make sure that it doesn't affect my ability to do the right thing from a risk perspective. And lastly, for those who want to have a more detailed look at the actual operations, you can go to their website. They run the Ashmore Tavern, the Apsley Central Tavern. They're all kind of in Brisbane, different areas. So you could say potentially a little bit of diversification. It's all still in Brisbane, it's all still in Australia, so questionable how much diversification. But that's why we have more than one trade in the portfolio and more than one strategy, because we're not counting on one stock being its own diversification. Lastly, investment properties. Aspley Property, it's a shopping centre. And the Plo Inn, which is I believe it's a heritage building which has been around for quite a while in Brisbane. They're sort of like a pub as well, host functions. They did purchase this for about 14 million cash, which I do find a little bit questionable in terms of, although they're not actually running the operations, they're just collecting the lease. I do find it a little bit questionable as to if buying this place for 14 million and then collecting the lease or the rent from the tenant is actually going to be enough. But I'll keep an eye on it, and it does seem to have boosted revenues and profits more than keeping the line of credit open and unused. So really that's it for this video. Thank you for your time, and we'll see how it pans out.